Welcome to the session on Smart Beta. My name is Sabrina Callin. I'm a managing director at PIMCO, Pacific Investment Management Company, based at our headquarters in Newport Beach, and I am the head of all of our equity strategies on the product management side of our business. So how many of you have heard of the term Smart Beta? Okay, well, we're going to fix that for those of you who haven't heard of it today. I'm going to focus on definitions around Smart Beta, what the value proposition for investors is that's offered by Smart Beta strategies, and importantly, what are some of the key considerations for investors when evaluating different types of Smart Beta strategies. I think an article released by Bloomberg earlier this week said that 1 in 5 ETFs globally are now Smart Beta strategies, and the assets under management just in the ETF space is around $400 billion. If you add the institutional assets and the other fund assets, that's probably well over $500 billion in Smart Beta strategies. So I don't think these strategies are going away anytime soon, and we at PIMCO think that's a good thing because we do think there's a lot of value that these strategies offer to investors. Let's see if I get the technology right. There we go. So there's a range of different Smart Beta strategies available, increasing range, I should say, of different Smart Beta strategies available to investors today, including strategies like equal weighted strategies, strategies that are weighted by fundamental characteristics like sales, dividends, cash flow, strategies that are based on optimization techniques, and then also an increasing range of factor-based strategies, many of which fall into the Smart Beta category. And Smart Beta strategies, I think most would agree, fall somewhere between traditional passive strategies, so just passively replicating a market cap benchmark like the S&P 500, and traditional active strategies, which is where a manager is picking the stocks that they hold in their portfolio. So why do we need a third category? What is the value of this third category? And that's, again, a lot of what I'm going to talk about today. But I think it could be sort of simply thought of as follows. Sometimes it can be difficult, especially in really efficient markets, to identify a manager who's going to consistently pick the stocks that are going to outperform the market, right? I mean, that's why we've seen such a significant increase in flows into passive index funds, right? Especially in U.S. large cap space, because many active managers have failed to outperform the market in, the U.S., the S&P 500 or the Russell 1000 or the Russell 3000 after fees. And so if it's hard to identify an active manager who can outperform after fees, why not just pay lower fees and go into an S&P 500 index fund as an example, right? You can invest in S&P 500 index fund, I think these days for single basis points, right? 5 basis points or 9 basis points or something like that. So really cheap to get passive market exposure. What's the problem with that? Well, the market isn't perfectly efficient. And how do we know the market's not perfectly efficient? Well, twice this century, we've seen the market, the S&P 500 as an example, fall by over 50%, right? When the tech bubble burst, and again during the financial market crisis. And if all stocks were perfectly priced at their fair values at all points in time, and all sectors were fair value priced at all points in time, you wouldn't have the technology sector in the Russell 1000 growth index, as an example, going from 44% down to 22% in such a short period of time, or the composition of the financial stocks going from almost 40% of the Russell 1000 value index down to below 20%, again, in a really short period of time. So we do have bubbles in the stock market. The stock market is not perfectly efficient, and the bubbles can be quite painful on the way down. And what we know, just looking at patterns over time, is that stocks do tend to exhibit momentum in the short term. So when stocks are going up, they tend to keep going up over the short term, but then they tend to mean revert over the long term. And it kind of makes sense when you think about it from a logical perspective. It's difficult to know what a company's worth what a stock price should be at any moment in time. But over the long period, as more information comes to light, prices do tend to correct. And so you see this mean reversion persist over time in the stock market. To give a great example, an extreme example, admittedly, of the fact that the stock market's not perfectly efficient, we can look at Cisco in the tech bubble and bubble bursting period. 1999, Cisco's weight in the, I think this is the Russell 1000 index, was just over 1.5%. Stock price was just over $30. 2000, Cisco 4%, just over 4% of the index in that very short period of time, and stock price had more than doubled up to $80, sorry. So what happened? Did Cisco change fundamentally in that short period of time? Did it become a significantly better company in 1 year's time? Of course not, right? It's just that the price kept going up and up and up and up and up because everybody wanted to own Cisco. So what happens if you're investing in the Russell 1000 index? It's a cap-weighted index. What does that mean? It means that it buys stocks according to market capitalization, stock price, times shares outstanding. So what happens when Cisco's price goes from over 30 to over 80 in a year? The cap-weighted market index buys more and more and more Cisco effectively. It owns more and more Cisco. That's why you see the weight increase significantly. And then when Cisco's price falls, not because it's a bad company, but people just came to the realization that it was overpriced, what happens? The index dramatically reduces the weight in Cisco. So if you own the index, what are you doing effectively here?
Buying high.
Right, exactly. You're buying rich as the price goes up, buying more and more and more and more Cisco, and selling cheap. As the price goes down, selling more and more Cisco. So is this what you want to do as an investor? Buy rich, sell cheap? No. That's not what we want to do. That's the opposite of what we want to do as investors. We want to buy cheap and sell rich. That's how you make money. And that's kind of the point of investing, to make money. But as an investor in a market cap index, you're doing the opposite, because the index itself is linked directly to stock price. And so you own more of companies that are overpriced and less of companies that are underpriced than you would if they were priced at fair value. You see this same phenomenon when you look at past losers and past winners, and I think there's some psychology behind why this happens, why stocks become overvalued and undervalued, and it relates to the simple fact that we all like to own things that are popular, right, that are comfortable, stocks that everybody likes, companies that everybody likes, and sometimes people own them and want to own more of them regardless of whether they're fairly valued, right? Like pick a company that everybody thinks is the future of the world, and you'd like to have that company in your portfolio. Pick a company that maybe's had some bad news around it, something like that. Maybe it's sort of old generation, not next generation. Well, nobody wants to have that stock in their portfolio. So what happens? The stocks that everybody wants to own, they become expensive relative to their fair value. And the stocks that are sort of out of favor, that nobody wants to own, relative to their fair value, they become cheap and they become undervalued. And you see this if you look, this sort of economic effect, if you look at the past losers here in the blue and the past winners. This is a period 1933 to 1980, just to use two different sample periods. You pick the stocks that had sort of been the previous losers and the stocks that have been the previous winners. In both periods, you see 25 to 30% outperformance in the subsequent period of the loser stocks by the winner stocks, right? And I mean, the losers outperform the winners. Why? Because the loser stocks were undervalued and the winner stocks were overvalued. So what can we do about it? That's where smart beta comes in. That's where this third category that falls between traditional passive, replicating a market cap weighted index, and traditional active, where a person is picking the stocks to own, comes into play. Smart beta strategies, at least the way we define them at PIMCO, are simply a systematic, rules-based approach to taking stock market risk, taking stock market beta, if you will, that breaks the link between the stock price and that stock's weight in a portfolio. And in doing so, contra-trades against the market's price changes. So price doesn't come into play at all in portfolio construction. That's what I mean when I say it's a systematic approach. So it's a rules-based approach, no human emotion involved, no sort of wanting to own the popular things and not wanting to own the unpopular things. It's a systematic approach where price is not part of the equation, either in terms of establishing the universe of securities or weighting those securities, as it is with the S&P 500, the Russell 1000, and so on and so forth. And so really what you have with a smart beta strategy is something that offers the best of both worlds, falls between passive and active. When I say the best of both worlds, why do you invest in active strategies even though you have to pay more to invest in the active strategies? You do so because you want something that's going to outperform the market, right? You're paying more because you want market outperformance. Well, smart beta strategies offer market outperformance, but they do so with many of the benefits of passive strategies. The process is entirely transparent because it's rules-based, right? It's understandable. You know what the process is that you're buying. Also because it's rules-based, smart beta strategies tend to be cheaper, right? Because you don't need to pay somebody to do a lot of company-specific research as you need to with traditional active strategies, again, because it's a rules-based approach. So again, benefits of both active and passive. Importantly, the ability to outperform, but with a rules-based process and a price tag that tends to be cheaper than traditional active strategies. How do all these strategies outperform? Why do they outperform smart beta strategies? Again, because they are breaking the link between price and portfolio weight. So they're removing that performance drag that comes from what? Buying rich and selling cheap, right? And so by removing that performance drag, you introduce market outperformance over time. Of course, not every day, every week, every year necessarily, but over time. And that's what we see no matter what the methodology is we use. This research paper that I'm referring to here on this slide looked simply at a cap-weighted portfolio relative to, and this is 1964 to 2012. The research was published, I think, in late 2013, relative to a simple equal weighted approach. So this is take the universe of stocks and equal weight every stock instead of weighting by market capitalization, relative to a fundamentals weighted portfolio. And so here it's a matter of taking all the companies in the universe of publicly traded stocks and weighting them based on company size. So sales, book value, cash flow, dividend, instead of market capitalization. So you're still capturing big companies, but you're breaking the link with price. Third is a minimum variance strategy, another popular type of smart beta strategy. And here again, breaking the link with price, picking a portfolio that's designed to minimize volatility. And so your portfolio by definition is much lower volatility than the market itself. And then the fourth category, and this is the fun one, this is the monkey portfolio. And so what the researchers did here, sort of like Burt Mackill's book way back when, is they simulated through the power of technology the average of 100 monkeys throwing darts to pick stocks. And so this portfolio was, not based on price, right? Because it's just wherever the monkey's dart lands. And that portfolio, selected by the 100 monkeys, also outperformed over this period of time. Why? Because there was no sort of link with price and portfolio weight and portfolio holdings. And so you didn't have that performance drag that comes from systematically buying more and more and more of the overpriced stocks and buying rich and selling cheap. Mm-hmm.
Why do you think indices have become so popular? Because I've heard people say, well, if monkeys can do it, you might as well just do passive indexing. But as that chart shows, it doesn't necessarily add up.
Well, that's the that's the challenge, right? And that's where I think why smart beta strategies have become so popular so quickly as people have begun to understand more and more of this, is that fundamental stock selection, active stock picking, has been challenged. And I think when you consider the need to overcome higher fees, right, the volatility in the stock market, and all the unknown unknowns, right? And frankly, the psychology behind wanting to own things that are popular in your portfolio. And, it's not that there aren't active managers who don't, there are active managers who outperform, but frankly, there aren't a lot who outperform consistently. And so a lot of momentum has been created around passive strategies, because if you're not going to outperform, why pay higher fees, right? And that makes sense, right? If you're not going to outperform, you shouldn't pay higher fees, but smart beta offers you something sort of in between. Yes?
And if you're saying how it's rules-based, who's selecting the rules? How are the rules developed, I guess, so it outperforms?
Well, that's a very good point, because it's not traditional stock selection where somebody's picking the companies, but somebody is picking the rules, right? And that's an important consideration for investors. That's the important consideration for the investors. What is that process? And do I believe that process is one that makes sense and should lead to outperformance after fees over time, right? Or other objectives that I'm looking to realize as an investor. And some of the considerations are risk, right? What type of risk is the process likely to produce, maybe relative to a traditional passive index as an example? And am I comfortable with that risk? Is that risk profile something that I embrace, right? Obviously risk and risk tolerance is one of the fundamental important considerations in investing. And you look at the 4 different smart beta strategies that I was referencing on the prior slide. And what you see, of course, minimum variance, a strategy designed to optimize around a lower volatility target, is going to be the lowest volatility strategy. The fundamentally weighted, very similar volatility to the cap-weighted index, again, because these are large companies. And the cap-weighted is sort of large companies but by market cap versus large companies by fundamentals. And then you look at the monkey portfolio and the equal-weighted portfolio, and not surprisingly, those portfolios are more volatile. Why are they more volatile? Well, they necessarily have a materially greater percentage of small cap stocks, right? Smaller companies, smaller capitalization stocks, which tend to be less well-established, more volatile stocks from a pricing standpoint. Because if you're equal weighting versus weighting by market cap or weighting by fundamentals, you're going to have the greater percentage of the smaller companies. Same thing with the monkeys. They're going to pick more of those smaller companies than if you're weighting by size. So risk is a consideration. Another important consideration in evaluating the different processes that the different providers have developed is cost, right? When you do something on paper, like look at the portfolio of 100 monkeys, you're not considering the costs of trading the stocks in the monkey portfolio. And if you have a lot of less liquid stocks in your portfolio, the trading costs will be higher, right? It's more expensive to trade less liquid stocks. It's also the case that if your strategy has higher turnover, meaning that when you rebalance, which is one of the key points here, right? As stock prices change, you need to rebalance back to your methodology, whatever it is, equal weighted, fundamentals, et cetera. But if the turnover is high, meaning that you have to buy and sell a lot of stocks at every rebalance date, that creates a lot of costs as well, right? Because every time you buy and sell a stock, there's a transaction cost associated with that. So you have magnitude of transaction costs, and you also have the sort of amount of trading you do in the portfolio as important drivers of costs that will bring down your excess return in reality. And so again, looking at the portfolios earlier, of course the cap weighted by definition has the greatest market cap, since that's the methodology. Fundamentals weighted, pretty high market cap as well, also because again these are large companies by definition, just measured by fundamental size rather than market cap. And then you have a pretty substantial decline in market cap when you move to the other approaches. Again, not surprisingly, because these approaches aren't based on size. They're based on monkeys throwing darts and other things. Turnover. Cap weighted, again, by definition, is going to be the lowest turnover because the index provider, while they'll change some names at the very edge, it's buy it through a process, and you don't need to buy and sell really if you hold that portfolio very much, right? Because you're just consistently owning the stocks in the index. You only need to trade if the index provider changes the names at the margin. Fundamentals weighted, again, these are larger companies. There is more turnover, but not extraordinarily high turnover, and then you go up from there. The monkeys, obviously, it's completely random each time, and so that's where you're going to have the highest turnover, those 100 monkeys throwing their darts, but also with the minimum variance and equal weighted, some higher turnover relative to, certainly relative to cap weighted or even fundamentals based. Again, turnover an important consideration because every time you buy or sell a stock, there's a transaction cost. So those are some important considerations. And then there's also the logic behind the process, right? We know that really any process that breaks the link should produce an excess return, but are there other sort of investment considerations beyond trading costs that you should consider and be comfortable with? And certainly the answer there is yes. But fundamentally, even though smart beta strategies have become really popular and there's almost an overwhelming number of different methodologies to choose from these days, one thing I wanted to emphasize is that these concepts are not new. This isn't, the fundamental principles here, including the idea of buying cheap and selling rich, are not new to investing. Just to quote Ben Graham from his classic book in 1949, price fluctuations have only one significant meaning for the true investor. They provide her with an opportunity to buy wisely when prices fall sharply and to sell wisely when they advance a great deal. Okay, so that's again the fundamental principle of investing. All smart beta strategies are doing is offering investors a way to systematically do this in a disciplined way, and perhaps to do it better because you're removing human emotion through the rules-based process. And then when you look at Fama French as well, and their three-factor model, what they said is really there are three sources that explain stock market return. One is the market factor beta, what we think of as stock market beta. The other is the value factor, and then the third is the small cap factor, and that the more value exposure relative to the market, the more small cap exposure, then you receive a return premium over time. And most smart beta strategies, really by definition, all smart beta strategies should have a value bias relative to the market, right? And then many have a small cap bias as well, as we saw with, for example, the equal weighted strategy. Of course, there's a big small cap bias relative to the market itself there. We can't talk about smart beta without talking about factors these days, and so I wanted to share some thoughts on the factor front, because as smart beta has become popular and people have increasingly been talking about different factors that drive market returns, we've had this explosion in the number of factors out there that people have identified and published papers on as providing robust factor premiums over time. Fama and French published their three-factor model a long time ago, but these days I think upwards of, approaching 300, 400 factors have been identified by people who have published papers on them and the like, and said, here's my new factor that really works and you should invest in it, and here's my back test that proves that it works. And of course we don't see the factors that don't work, we only see the factors that do work. But how do you navigate this, right? How do you think of all of these different factors and determine which are sort of economically robust, where the premium that's been identified should persist in the future, and which factors maybe are just data mining, finding something that works and publishing it or creating a product around it? Because these numbers are kind of scary, right? So a lot of words on this page, I know, but I think, and this gets to your question, I think the primary principle here is that for a factor to persist over time, as an investor, you want to make sure that whatever that factor is that a particular smart beta strategy or other strategy is looking to provide you with, whatever exposure that strategy is looking to provide you with to capture that supposed market premium, is one that makes sense, right? There's a logical reason. It's not just, here's my back test, and so buy my strategy. It's that there's a logical reason that that factor should provide a return premium relative to the market as a whole over time. And then some other considerations when you're sort of digging into the research, in evaluating different factors, making sure that the, factor, and this gets more to sort of the academic community, but that it's survived various database revisions, out of sample data testing, that it's been vetted and replicated by a number of different people, not just one person or one provider, that it's evident that it exists across markets, not just in one market, but then it doesn't work in another market, because that wouldn't really make sense unless there's some really unique factor or consideration for that particular market where it works that doesn't exist in other markets. And you want to make sure that it doesn't materially vary if you sort of tweak it minorly, because then it's probably not a robust premium that will stand the test of time. That's kind of the point when you're evaluating these different strategies, right? You're investing at this point in time, you're looking at prior returns, but you're not going to receive those prior returns. So what you want to make sure is that whatever you're investing in is something that should work in the future, and that whatever factor is being captured is something that should be robust on a go-forward basis, in addition to being robust on a backward-looking basis. And what the research shows is that the value premium and the market premium, incredibly robust. Small cap premium, I think the research would still say is robust, although again, that's with a trade-off of what can be pretty materially higher risk or volatility, back to risk being an important consideration. Other factors, illiquidity, that stands to reason as well, right? You should be paid a premium for something that's less liquid. Low volatility is a less intuitive one, and I'll get to that in a moment. And momentum, also some market premiums that appear to be fairly robust over time, meet the criteria here on this page. Interestingly, and I'll speak to this here in a moment, quality has been something that there's been a lot of talk around, and it's intuitively appealing, right? Invest in quality companies, that makes sense, right? And that's something where a quality factor, in the way that most market participants are defining it, and most practitioners are creating product around it, isn't something that appears to be robust in terms of providing a premium over time. And again, I'll get to that in just a minute. Low volatility, this is an interesting one, and actually we've seen a lot of growth in low volatility strategies with an intuitive appeal there, I suppose, following the financial market crisis and the tech bubble bursting. Maybe some lower risk equity investing is on the order, right? But why would there be a premium return to lower volatility stocks? It sort of doesn't make sense if you're supposed to be paid a premium for taking higher risk, right? And there isn't necessarily, on a risk-adjusted basis, a significant premium, but some of the reasons that you might see a premium, even a modest premium, without considering risk, so you're actually taking less risk but you're earning a slightly more return, have to do with I think probably the most intuitive is a preference for gambling, right? If you have a more volatile stock, it can go down a lot, but it can go up a lot, right? Why do people buy lottery tickets, right? They know that the probability is that they're not going to win the lottery. What were they saying the California Powerball was up to the other day? I mean, you hear that on the radio or whatever, and it's like $300 million. I know I'm getting that wrong, but it's appealing, right? It's appealing. What would I do with the 300 million? And so there's a certain appeal of higher volatility stocks, of companies where their stock prices are more volatile, because maybe that's the next Apple, right? Maybe I'm going to get rich. And I think that is fairly intuitive versus lower volatility stocks, not that exciting. I'm investing in stocks because I want to make money. Why do I want to invest in something that's not going to go up a ton, right? Or not going to go up a ton relative to the higher volatility stocks. There also is some evidence that analysts that people tend to, the research people read when picking stocks, tend to be overly optimistic on more volatile stocks, right? They can get excited around the names that they think are going to go up a lot, and maybe their, psychology is such that they tend to be more optimistic. They want to pick that next big winner, right? And so maybe that creates a slight bias towards more volatile versus less volatile stocks. There's also some research around this idea that many investors are leverage constrained. They can't use leverage to get higher returns, and so maybe higher beta stocks is a way to increase your return on a dollar invested, right? And so you even see this in the mutual fund industry, where if, let's say, a mutual fund needs to have a certain amount of cash in the portfolio to meet redemptions from investors, but they want to keep their beta in line, their sensitivity in line with the market as a whole. Maybe on average they hold slightly higher volatile stocks. They have a market beta that's in line with the index, even though they maybe have a 5% cash position in the portfolio to meet redemptions from investors. And so these are some of the considerations that would support a slight modest premium before adjusting for risk with lower volatility approaches. Short-term momentum, that's, I think, fairly evident. Again, we do see over time that stocks that are going up tend to go up. And so if you can execute that right, and that's the key, then there is a return on that premium. But momentum, I think, is something that can be difficult to execute because, of course, when is it going to go against you? When are you going to be at this point, right? So evidence of a premium, but perhaps harder to execute than a lower volatility strategy or a value strategy in practice. Now to quality, right? That is counterintuitive, just like low vol is counterintuitive. Why would I not want to own quality stocks? Of course I want to own quality companies, right? What gets down to valuation, right? The fundamental principle that really underlies the value of smart beta strategies. A high quality company is probably a company that everybody wants to own, right? And if everybody wants to own the company, are you going to buy cheap and sell rich by buying quality companies that everybody knows that are quality companies, right? No, I mean, maybe they're fair value priced, but if they're well-known quality companies, they're probably not cheaply priced. And you probably shouldn't receive a premium for owning quality companies, right? Relative to the market as a whole. And so just purely based on the way that many of these quality factor strategies are constructed, there doesn't seem to be a logical, persistent premium. Now, frankly, there's been a lot of momentum, the prior slide, behind quality investing lately. And so you actually have seen a lot of these strategies do very well. But the question is, have they done very well because those quality companies have been bid up? And so the change in price is sort of resulted in them looking like a very successful investment strategy? Or is it because there's a fundamental premium available that should persist over time? And I think that there's not so much evidence that it's a persistent premium relative to the market that's available over time to investors. Now, the way to adjust for that, of course, is to bring valuation into the picture. Yes. Right, got it. Okay. So if you start with a process that, let's say, adjust, so you're owning companies that are on average cheaper than the market, let's say by picking stocks based on fundamentals rather than market cap, and then you pull the highest quality companies out of that group of stocks that is already cheaper relative to the market on average, then you can see a higher return to quality. But first, the discipline is sort of inserting that valuation process in there, breaking that link with price. And this is exactly what the fundamental index strategy and PIMCO's research affiliates fundamental methodology does, just to give you an example of a practical strategy. Again, there's many different strategies out there. This is a methodology behind one where the Rob Bernat and his team are picking stocks through a systematic process that selects and weights the companies, the stocks of the companies, by sales, cash flow, dividend, and book value. So entirely rules-based, entirely transparent, and then further adjusts after this, breaking the link between price and weight to emphasize companies that are higher quality based on financial metrics that have demonstrated some short-term momentum or positive momentum, de-emphasize companies that have demonstrated some negative short-term momentum, to diversify by style, to diversify by size further. And so again, entirely rules-based process, and what you do see over time is not outperformance every week, every month, every year, but pretty consistent outperformance over time. And this goes all the way back to 1965. Again, it's rules-based, so you can create robust back tests here. It's actually been live for over a decade, so the live data is in here as well. And what you see is outperformance in 86% of 3-year periods, which is really outstanding relative to the universe of choices as a whole, in U.S. large cap space in particular. Periods of underperformance, the yellow here up on the chart, versus the S&P are periods where what was happening? The rich stocks were getting richer and richer and richer and richer, and of course those are the periods where a strategy like this is going to underperform until it outperforms dramatically, right? When you see that mean reversion really come into play. And that's actually what we've seen this year. This is through the end of 2015 here, as certain stocks, and there's pages here that we're not going to have time to go through, but you've seen pretty significant divergence, really a pretty significant anomaly between value and growth. Value typically outperforms growth over periods of any material length. Again, that's a robust factor. That has not been the case over the past 10 years. And the relative outperformance of growth versus value had actually gotten to levels approaching where we were going into the tech bubble. We haven't seen a dramatic reversal of that this year, as much as we have seen some mean reversion, including amongst some of the stocks that were really singularly driving markets around the world in 2015 as an example. I think what had been referred to as FANG here in the US, Facebook, Alphabet, including Google, Amazon. And so we've seen again some reversals of that, of the most expensive stocks getting more and more and more and more and more expensive, and the cheapest stocks getting, well, at least not significantly cheaper, but certainly relative to the most expensive stocks underperforming. And this year that the fundamentals-based systematic smart beta strategy is outperforming around the different markets year to date, and so that's just not even 4 months of the year, by anywhere from 2.5% to over 10%. And so when the markets, when you see even some amount of mean reversion, again, following periods of underperformance, like we saw there, this is over 3-year periods. The underperformance was larger over the 1-year period. Again, you're capitalizing on mean reversion. You're capitalizing on systematically selling rich and buying cheap. It does tend to persistently work over periods of time. So just to wrap up, we believe Smart Beta provides investors with a very attractive solution that allows you to capitalize on market inefficiencies, capitalize on mean reversion over time by breaking the link between stock price and portfolio weight and trading against the market's price changes, right? And there are a growing range of strategies available, but importantly, how do you evaluate the different strategies? Key considerations include, what are the likely transaction costs, trading costs, turnover, type considerations, what are the sources of return and risk, what is the process, does it logically make sense that the drivers of return should persist going forward, and does it break the link between price and portfolio weight so that you're eliminating that drag between that drag of systematically buying rich and selling cheap. Questions?
You covered a lot.
Thank you very much.
Oh, well, thank you all.
Thank you.
And now I think if everyone wants to use the restroom or anything before we go back to the main meeting room for lunch.
Okay. Thank you.